For an update on the outlook for listed infrastructure, I'm joined here in the studio by Shane Hurst, Portfolio Manager at Clearbridge Investments. Shane, it's been a really volatile first half of 2025 for equities in the round. How's listed infrastructure performed through that?
Yeah, look, it has actually been a great environment for listed infrastructure. Volatility, underperformance of major markets leads to very strong performance of defensive assets. You throw into that, obviously, the Trump tariffs, which really affect most trading nations and most trading industries, but utilities and infrastructure tend to be more domestic based. And so in that type of environment, infrastructure and utilities have actually done very well.
But it's also been a volatile time for parts of the bond market.
Sure.
No, I mean, do some investors see infrastructure as a bit of a play on where fixed income is going? So how's that impacted valuations?
Yeah, look, bonds and themselves have actually been trading sideways largely. So, for us, that movement, if you think about the US bond yield, is kind of traded in between kind of 4.3 and 4.8. Just as long as they're range bound, I think it has very little impact. I think when they start to move up, people start to market it in their cost of capital. In the end, though, for a regulated utility, interestingly, they pass through inflation, through their regulation, through their regulatory constructs. For an infrastructure company, through tolls, through tariffs, etc. So there's no impact for inflation. For growth, they actually benefit from a stronger growth environment because you get greater traffic, you get greater flows, you get greater economic development. So, really, movement in bond yields and the impact of those components of bond yields in no way have been a negative for the space.
Well, that's what's been going on in the last 6 months. But how's the portfolio positioned today, and why have you positioned it that way?
Yeah, so the portfolio is still relatively defensively positioned. Around about 70% is in regulated or contracted utilities. Infrastructure's about 26, 27, and the rest is cash. So when I say infrastructure, roads, airports, rail, etc. So that is the current positioning. Interestingly, we still expect volatility over the next 6 to 9 months. Valuations in broader markets are relatively expensive. If you think about our space, there is still significant value, especially in the utilities and the infrastructure names. There are a number of drivers, whether it is AI and what that's going to bring to the space, the CapEx super cycle, which we are likely to see, and we have been seeing in the regulated utilities, driven by a number of kind of multi-decade themes, or the ability to pass through inflation. These are all themes that we expect will play out over the next few months.
You talked a bit about how your portfolio vis-a-vis utilities, infrastructure, but geographically, what's the spread of the portfolio, and how many stocks are you in?
Yeah, so in terms of spread, there's about 55% in North America, about 40% in Europe, UK. Stock-wise, we tends to sit anywhere from about 30 to 35 within the portfolio.
Well, you mentioned a couple of big drivers of performance, or certainly drivers of infrastructure. AI you mentioned. So
Yeah.
How do you take a really big topic like that and think through what the implications are for your sector?
Yeah, it's actually massive, right? So when you think about AI, obviously there's a huge demand for electricity, and that's kind of the primary driver in our space. There are other drivers, obviously, with towers and operating at the edge in terms of AI, but the biggest driver is demand for electricity. So let's look at the US as an example. When a data center is put in a region, that regulated utility needs to do a number of things. Firstly, it needs to build generation, or at least supply electricity to that data center. It needs to facilitate transmission, distribution for that data center to link it up to the grid. And that's a positive for the state. It's a positive for the regulated utility, and certainly leads to growth going forward. And so for us, that's where we've seen a lot of the benefit in our space. I'll give you another example where we've seen the benefit. We own a company called Constellation. They own the largest nuclear fleet in the US, and obviously nuclear is carbon neutral, and one of the largest suppliers of electricity in the US, and certainly it has benefited from this extra demand for electricity.
Do you think there's almost a sustainability danger here, which is that if all of this power is going to corporates that are running data centers, it's not going to citizens and voters. And it could, some point, it could get ugly, and you might own a shareholding somewhere in the middle of that ugliness.
Yeah, true. Look, that is an absolute risk. And that's also why you invest in specialist infrastructure managers, because there are places around the world, there are states, areas where you do have that risk. And let me give you an example. Places like Portland, Oregon, you actually get the same tariff if you're a data center or whether you're a residential customer, which means you get greater rates as it relates to a residential customer. The areas that we invest in, they tend to have differential tariffs. So they have a higher tariff for a data center. And in fact, what that does is that supplements the tariff paid for a residential customer. And that is really the most crucial part of investing in a regulated utility, that ultimately the tariffs passed through to customers are not too onerous. And as a result of that, the regulator continues to be constructive.
You mentioned also the CapEx super cycle.
Yeah,
so
super cycle.
Yeah, so what's going on there?
That is, look, that's something that's certainly developed over the last few years, and there's a number of drivers of CapEx for utilities globally. So generally, utilities now are growing their asset base anywhere from 7 to 10% per annum. If you go back 20, 30 years, we're talking 1 to 2% per annum. So what's driving that? Firstly, electrification as we go and decarbonize networks, as we put in wind and solar, etc. Other areas like physical asset risk, so we've seen storms, we've seen wildfires, that leads to hardening of networks. Other areas like onshoring, which has led to big investments in places like the Gulf Coast of the US, and then other areas like AI, as we talked about. And so what that's led to is this sustained capital spend for a regulated utility in most parts of the world. You've also seen replacement capital spend in places like the UK, which has been a big driver.
Where are they getting the money from?
Yeah, look, capital markets are open to accretive investments, right? So when you have an investment that will generate an attractive equity return for an equity investor, obviously you'll find funding, and we haven't seen any issue for utilities, whether they're in Europe, UK, or the US, actually getting equity funding. Similar in debt markets, these are some of the highest rated debt companies globally. We're talking BBB plus or A. So their margins above government bond yields are very slim. So they really haven't had an issue funding that growth going forward. And for us, that's key, in addition, obviously, to their internally generated cash.
But what's your take on utilities in the UK? And I ask because, I suppose if you look at the headlines,
yes,
there's a bit of a sense here in the UK that whatever money there was in utilities has been taken out in dividends. They're all going bust, and there's not much left over for all the investment we need to do. Now, that's a very broad sort of headline view. I'm sure. That's not as true of every single company that's a utility in the UK, but broadly, that's the sentiment.
Yeah, and I think that's certainly what the press is pushing, and I think that's wrong. To be frank, I think there are a couple of companies that have had issues. Obviously, Thames and Southern Water. Thames is probably the worst of it, and that's due to mismanagement and the fact that they haven't been able to implement projects and deliver those on time, and as a result of that, have had issues. I actually sat down with all the water companies yesterday, and we had meetings with the CEOs. And sorry, these are the listed water companies. So there's 3 of them: Severn Trent, Pennon, and United Utilities. And these are some of the best run water companies in the UK, and they are doing exceptionally well. They have had forward capital plans approved and funded. We're talking 8 to 10% in the case of Severn Trent. Severn Trent's dividend yield is about 4.7%, and that's growing by inflation. The regulator themselves is very happy, and we sat down with the regulator with how Severn Trent and Pennon and United Utilities are being operating. EPA scores are high, rates are manageable. And so for the best run utilities in any market, whether it's Europe, UK, the US, they get rewarded by the regulator. They also get rewarded through capital markets. And certainly again, the benefit of investing in a specialist infrastructure strategy that we can actually find and isolate those opportunities.
Well, you mentioned the listed companies.
Yeah.
I mean, what are you seeing any valuation differentials between listed and unlisted companies, and what's that telling you?
Yeah, look, there is a lot of capital sitting on the sidelines in unlisted companies. In unlisted funds. And these are your KKRs, your BlackRocks, etc. And that's just waiting to find opportunities, whether they're listed or unlisted. So we continue to see a bid for listed assets from unlisted capital, and that's really been a benefit for us historically. Whether it's taking companies entirely private, whether it's privatizing assets, whether it's buying part of assets, there appears to still be that bid. And so as a result of that, certainly for individual assets, you have seen them trading at high levels in unlisted markets versus where they are in listed markets.
Right at the start, I think you alluded to the tariffs and all sorts of volatilities and fun and games going on in the markets. What sort of impact is that having within the infrastructure space? I mean, presumably there's roads, ports, airports. That's got to have an impact on.
Look, for our portfolio, actually very little. When you think about the skew, as we talked about earlier, about 70% is regulated or contracted utility, so very domestic based. Roads themselves service domestic traffic. And so where the impact has been in rail, really for the most part, and a little bit in pipelines. I say rail has been the biggest focus, and we own less than 5% of the portfolio in US haulage rail. So this is moving goods around the US. Really, the news has been changing continuously, but what we've seen is actually a pull forward in demand, and we as yet have not seen a lull. So that's definitely one to watch, but it's also reflected in valuations, which are very attractive.
Everything you're saying is really positive about infrastructure, but what are the risks that keep you up at night?
Yeah, look, the biggest risk for me is pressure on rates. And to the points we've talked about earlier, when you have a lot of capital to deploy, when you have a constructive regulator, the biggest risk is that you're pushing through rates that are higher than inflation, substantially higher than inflation, and ultimately customers don't see the value. And that leads politicians to be less constructive, regulators to be less constructive. So if there's one thing that really worries me, it is that. And that's something we explored in detail when we were in the US last week. Europe this week is just what is the pressure on rates, because we don't want to be in a region like Portland where you do have that huge exposure to really high rates, or Connecticut in the US, where it's not manageable, because that just leads to poor returns and pushback and ultimately underperformance from these assets.
What sort of future do renewables have as a power source or investment opportunity?
Yeah, I mean they are a fantastic power source. They're clearly intermittent, so they don't operate all the time like a coal or a gas or a nuclear plant. But they also have the ability to not be fueled. I mean, they're fueled by wind and solar, etc. I'd say obviously they need to be supplemented in any grid by what they call a base load or a shoulder load, so gas or coal or nuclear, and there are areas of the world like Spain or Portugal where you have seen that go a little bit too far, resulting in kind of zero electricity type hours. But by and large, they are a very, very sustainable fuel source going forward, and certainly positive for the environment. Obviously, there's been a lot of noise, and I'm probably jumping into your next question, lately in the US with the Inflation Reduction Act. But the reality is, even in places like the US, you can't get a gas turbine for 3 to 4 years because there's just no availability. So you need to build wind and solar and bring in battery if you want to fund if you want to supply the growth needed for AI demand and for greater demand for electricity. And really, places around the world, whether in Europe or in the UK, you continue to need wind and solar as a generation source.
If you're looking to build out wind and solar in the States, who's the more important person to have on site? Is it the President of the United States, or is it the governor of the individual state where you want to put these structures in?
Yeah, look, I think that's a very fair point. I think it probably is the governor ultimately, and the legislature and the regulator. state regulations tend to drive most of the investment in renewables in terms of incentives. I think federal does have an impact. Obviously, production tax credits and ITCs as well do impact how renewables are invested in. But in the end, they are mostly state-based policies which drive capital plans and what they call integrated resource plans for regulated utilities.
Final quick question. Sum it up. Why should investors think about having listed infrastructure as part of their overall portfolio today?
Yeah, look, the time is fantastic. I mean, valuations are attractive on our forward-looking measure of IRR. It's greater than 11% at the moment, so that's a very attractive place to be. That implies essentially on expectations, no guarantees. Obviously, this is just our forecast. An over 11% per annum return over the next 5 years, total return. From our strategy, the income strategy, you're getting a circa 4.5% to 5% income through the cycle. We've talked about those themes, whether they're AI-driven, CapEx super cycle, the ability to pass through inflation, the opportunities we actually are seeing in places like renewables, which have sold down because of the noise around Trump. That's another reason. And then finally, to highlight, these are essential services. These are assets that operate through the cycle, not the business cycle, which are able to pass through inflation and are also able to grow in a very stable, sustainable way, such that it can produce very stable cash flows, earnings, and ultimately dividends.
We have to leave it there. Shane Hurst, thank you.
Thank you very much.